back, everybody. This is my Daily Dose with Tim, and today is Season 2, Episode 17. So, as you guys probably already know, we are continuing on with the BRRRR train. So, what that means is we've been kind of covering this ever since the beginning of last week as well, so since Episode 11. So, this is the 7th episode in. We started from flipping all the way to BRRRRing, and now we're actually doing performance audits now, and because it's so important, simply because at the end of the day, yes, we can BRRRR anything we would like. However, the bottom line is it's gotta fit your financial goals, and what that means is how well is it performing at, and if it's performing well, does it actually contribute directly to hitting your financial goals in a timely manner. However, that is something that we actually covered yesterday. So today, what I really want to do with everybody is the fact that I want to start to show you guys in terms of what some of the calculations that we did before even getting into this deal. Okay, so today I'm just going to be a little doom and gloom a little bit because it's all about making sure that we are protected, meaning I like to forecast what potentially a worst case scenario could be. Okay, so here is what it is. So I'm going to quickly do a recap on all the numbers that we have gone through. I've done a quick summary here for everybody, just so that later on when we come back to this page to do our calculations, it's a lot easier to follow and you can actually see everything on the same sheet. However, if we were to go back to, I don't even know which day this was now. Let's see. I think this was when we were talking about some of the baseline conditions. So you can see episode 14 and 15. So probably 14, 15 there. Anyways, the point is, showcase one of the deals that we just did in our home market right here, and the total amount that we put into this property is $305,160. And if you missed this part, make sure you go back to it. That basically includes everything. And the final number when it was appraised was $385,000, even though the forecasted ARV was supposed to be $330,000 and $330,000 to $370,000 range. So we kind of did a little better there. And also what happened at the end was the fact that when we got it reappraised and refinanced, we were able to get a mortgage at 80% loan to value, meaning we're leaving about 20% of the appraised value on the table, so we're not taking every last penny out, okay? Even though technically we still did, because we actually did not spend $385,000 to get into it. We spent $305,000 something, okay? And then I mentioned that this was actually in a case where we had to access non-A lenders, which means we had to pay for a fee as well. And that was already all calculated and factored into the total money putting into the deal. So that sort of brings us to where we are today. I'm sort of alternating between the fat markers and the skinny marker just so that I can fit a little bit more on the same page, okay? So the actual scenario, like we said, money in is $305,160, and the ARV, or the appraised value at the end of the day, is $385,000. And the loan to value, that is 80% at 3.45% with a 1% lender fee. So $308,000 is the money that we actually pulled out at the end of the day, and the actual rent on this property is $1,980. So here is, I'm going to walk you through the worst case scenario that we actually thought about when we were doing this deal, okay? So first thing first, what could be the worst case scenario? When we were told that the after repair value, the range is, remember, 330 to 370. That's a big chunk, okay? So we covered this last week already. How you can really determine that really is that you have some slight control over it by the quality of the finished product that you put out there into the market space, okay? However, let's just go with the lowest end at 330. Now, for some of you guys, you might even argue that, whoa, if it's 330 for me, the low end really, that I want, if I want to be super safe about it, I probably go even lower. However, you need to remember, if you build your power team properly, meaning in this particular case, your realtor fully understands what it is that you are accomplishing, they will already tell you, you know what, honestly, 330 is the bottom line, okay? They would be willing to hang up their license if it goes below 330. COVID, no COVID, recession, no recession. And honestly though, how they come up with those numbers, as you probably already know, because ARV is a lot of times known as our new CMA, our new comps, and that's sold comps, meaning really what the demands are for the product and the market that you're in. And so $330,000 is really the low end of that, number one. Number two, when we are doing the refi, there are times you will go as low as 65% loan to value. 65% loan to value. So if you want to take out your calculators quickly, 330,000, 65% loan to value means that you actually pull out 214,500. 214,500. And fair market rent. Okay, the fair market rent for this type of property in this kind of space, it was $1,850 all the way to about $2,100. So low end is definitely $1,850 in this particular case. So let's begin the new calculation, shall we? So I'm gonna put this here for as much as I possibly can so that we don't lose it all and so that I don't have to keep flipping back and forth with you. All right, so if total money in, let's put it this way, because I think I drew this for you before, money in, money out, right? So if total money in is 305,160, and in this particular case, the amount of money out is 214,500. So that means, first of all, money left on the table, or money left in the deal, is the difference between these two numbers. So let's take a quick calculation there. So 90,660. 90,660. Okay? That's the total amount of money left in the deal. Now the second thing is, if we were going to do that, let's come up with our new expenses, because what are we doing here? It's all about performance audit, right? So revenue minus expenses, and we know expenses is PITI, and revenue in this particular case, let's just say we're on the low end, 1,850. You can get this number by doing some of your own due diligence as well on all the rental sites, online classifieds, and even local realtors as well as property management companies. That's where you can actually get that number to run your calculations with. And then when it comes to PI, remember, I introduced you to a mortgage calculator. If you're Canadian, it says Canadian Mortgage Calculator. And if you're from any other countries watching this right now, you can actually just utilize any sort of regular mortgage calculator that's non-Canadian. Okay, I'll explain that later on. Not the most important thing at the moment. However, let's take a look at this. So what this really means is we're going to punch in under home price $330,000, and then the down payment, in this case, because it's 65% loan to value, meaning we're leaving 35% in. So under down payment, what you would do is punch in 35%. And in terms of monthly, okay, now, one more consideration here is when it comes to which color do I want to use now? Let's see. Let's use purple for this, okay? We the actual scenario right now is we got 80% loan to value at 3.45%. When we were doing this deal and forecasting this, we actually were quoted that depending on our final investor's qualification, we might even go up to 4.89% in terms of interest rate and 25 years in amortization, and we would have to come up with a 1% fee. Okay, we would have to come up with a 1% fee. So as you can see, 1% is already factored into the 305 in the beginning when we were doing refi, actually a little less. However, I'm not going to be splitting hair at the moment yet, okay? I just want to utilize some of those numbers right now, and we'll get the calculations going. So from a PI perspective, let's make sure that we change the interest rate to 4.89 on our calculators, and then we have 25 years instead of 30. So the shorter the amortization term, the bigger the monthly payment is, because you have less time to pay back the total amount that you owe. Okay, so what that means now is our mortgage payment is 1234.14. So can we just say, instead of 1234, that sounds good, but I'm gonna round it up into 1235. Once again, underestimate your revenue, overestimate your expenses. However, just in case not everybody has been following or are using the app right at the moment, I don't want to over confuse you, so I'm just gonna round it up by a tiny bit. And by a tiny bit, I mean about 86 cents right now. And yesterday we already showed you that the taxes and insurance per month is $435. So really, the total expenses added up, here we have $1670. We have $1670. So what that really means is, based on this scenario, we have a cash flow of $1850 minus $1670. So it's actually $180 on a monthly basis. So hey, remember, two top priorities. Number one, cash flow. Number two, return on investment or cash on cash return. Have we checked off the first priority yet? Absolutely. It is a viable business, meaning that it is actually cash flowing. Now, a lot of you guys are going to fight me on this now, because during season one, remember, I already mentioned that yesterday and the day before, if it's an actual income properties, especially multi-doors, the calculations on something like this would be different. Just because it is a single family homes, a lot of the times I will let you guys take your own liberty in terms of how you want to really factor in the calculations. The biggest things that are missing at the moment, okay, are these two things right now. Number one, property management fees. Number two is repair and maintenance. Now, we're skipping that at the moment simply because, number one, a lot of you guys, when it comes to smaller income properties, I know you do have the tendency to self-manage. So if you want to do that, make sure you factor that in based on your market rate as well. And you'll probably find, because our cash flow is 180, that's not even 10% of our rent, that might actually completely eat your cash flow away. So if this property is not within my hometown where I can actually entertain the concept of self-management, then I would not even actually do it, okay? So number two, repair and maintenance. Now, for some of you guys, I would highly suggest that you still budget that in, 3%, 5%, whatever it may be, because we basically just did a complete reno. Meaning there shouldn't be anything too major that's happening, because if it was, if there was some major issues, you probably should have factored that in during your renovation process. And this is also one of the reasons why we always like to make money in the buy, meaning we can actually go in and do some refurb and renovations, just so that the maintenance and repair factors would actually go down. The risk of it would actually go down a little bit. However, do we have crystal balls in terms of what's going to happen? No, we don't. And so for some of you, if you still want to factor in a small percentage, that's completely up to you. Okay, so I'm just going to point out those two things right now. However, as is at the moment, just revenue minus your regular petty payment, we have a cash flow of 180. So that's not bad for some of us. given the fact that this is one single door, okay? Just one door, not multiple doors. And the other calculation now is, now that we've checked off cash flow, what about our cash on cash return? So we have 180 per month times 12 months. And then we're gonna divide it by money left in the deal, which is 90,660. So let's do that math together, shall we? Grab your calculator once again. So 180 times 12 months divided by money left in the deal. So we have, whoopsie, where did it go? Hang on. 180 times 12 divided by 90600. And so what we have here is a whopping 2.38%. 2.38%. Okay? So this is what the worst case scenario would look like when we were running this analysis. Now, the next few days, I'm going to go into other variations as well. However, here is the question for you. Okay, I'm not saying that this is a smoking deal. However, I did mention this yesterday, is that at any given point, what we're looking to do is to round out our circle of wealth or our wheel of wealth so that we can run smoothly financially, right? So we have our earned income, portfolio income, passive income, and portfolio income. Now, most people are good on this if they have jobs. Some people are good on this if they're actually putting money away in, let's say, RSPs, 401ks, stock options, or savings accounts, or whatever it may be. Depends on where you live. What most of us don't have is this. However, let's just say that you're at the point in your investing career where, you know what, you got a nice job as a source of income, you got lease options going on, you got lending going on, you're flipping, you're good there, you got lease options here, you got lending here, you also got multi-unit family income properties going on here, you're also covered there, and here you're not growing as quickly as you would like. Well then, hey, you know what? Maybe it's okay for you to get something like this. Why? Because money left in the deal basically means that $90,660 goes into your portfolio income, or your equity income rather. So just remember, equity is like the piggy bank that you cannot open unless you're creative and have the right power team on your side. There are other ways to leverage that as well, but you might choose not to. Regardless of what the case, let's just say that this scenario as is, because you and I can both be splitting hair on how we can actually draw that equity out, and I get you. That's totally fine. However, the deal as is, you're basically adding the $90,660 into your portfolio income, and over time, let's just assume that the market value has not dropped or is not dropping moving forward. The more pay down, the more mortgage payments that you make from your rental income, the more equity or portfolio income you're adding for yourselves as well. So again, this may not be a good deal if you're just starting out, regardless of how great you think the BRRRR process might be. However, it all comes down to really recognizing the fact that you need to be very clear about your financial goals, leveraging real estate investing as a main vehicle to help you get there. So no right or wrong answers there. And that's really honestly the beauty about this whole thing is control, is you have control over how you want to build your income streams, how you want to build your long-term wealth, and the right deal for somebody else might not be the right deal for you. The right strategy and markets for somebody else might not be the same one for you. Over the last few years, I've taught anywhere at people between the age of 17 to 63. Do you think that they would have the exact same financial goals, even though they're all interested in wanting to get into real estate investing? No, their goals are vastly different and their resources available are vastly different. Their networks are vastly different. So what that ultimately means is that everybody is going to be looking for a tailored way to help them get wealthy, to get multiple income streams built. So remember, always go back to the basics, and I did a lot of the basics back in season 1 as well, so make sure you catch up on those videos. Okay, so that's what I wanted to share with you guys today. Once again, tomorrow we're going to go into what the best case scenario might be, so that's always something that we like, right? So that's it for today. Thank you so much for your engagement, for your likes, for your comments, and for your shares. I can see that you guys are really liking this whole segment right now, because this is the most shares I've experienced on any of these videos that I've been making since the beginning of summer this year. So thank you so much for your support, and I'm so glad that you're sharing the content and knowledge with the people that you think would really benefit from this. So keep doing that, and I appreciate you for it. And with that said, that's it for today. I will be back here with you tomorrow. So have a great evening and live well, everybody.